is a useful way of recording and summarizing financial information. Businesses use accounting to keep their financial information organized, which helps them in making sense of their financial data and also keeps them compliant with financial regulations. Accounting consists of two parts. One, bookkeeping. Two, analysis. Bookkeeping, which is also known as financial accounting, is the process of recording and summarizing financial information. Bookkeeping involves the recording of transactions such as sales, purchases, and expenses, which are then summarized and presented in the form of financial statements, which show the overall health of the business. Bookkeeping helps to organize the financial data, which facilitates the effective management of the business by providing key information, such as how profitable the business is, how much money business owes to lender, how much money customers owe to the business, how much tax needs to be paid, and so on. Bookkeeping is the backbone of the accounting system and forms the basis of analysis in management accounting. Management accounting provides information for decision-making, planning, and control of the business. For example, information relating to investment decisions, budgeting, and performance measurement.
Origin and evolution or history of accounting. The history of accounting is like the history of human civilization. So, we can say that accounting has been originated from the beginning of human civilization. The origin and evolution of accounting can be divided into the following four stages. 1. Development period, pre to 1494. The period from the beginning of civilization up to 1494 has been included in the primitive age. Primitive age can be divided into the following four ages. 1. Stone Age. In this age, people used different types of images, symbols, cave engraving for bookkeeping. 2. Ancient Age. In this age, people used to make knots with the help of ropes, by making marks on walls and bamboo for keeping accounts. 3. Exchange Age. In this era, people used to calculate the exchange of goods by painting the walls of the ground or carving wooden doors. In this age, an instrument called abacus was used in China for accounting. 4. Money Age. In this age, the currency was used as a medium of transaction. Cori, leather was used as a medium of transaction. 2. Pre-analytical periods, 1994 to 1800. During this period trade and commerce expanded rapidly. In this age, the great Italian mathematician Luca Pacioli is known as the father of accounting and bookkeeping, discovered the basis of accounting debit and credit of accounts. 3. Analytical period, 1800 to 1950. Basically, the propagation of modern accounting began in this era. In this age accounting research started and new theories were invented. 4. Current or modern period, post to 1950. During this time, there was a great change in the science of accounting. Accounting standards have issued and various branches of accounting have emerged. Nowadays accounts are kept in computers rather manually.
It takes detail orientation, math skills, and personal integrity to run the numbers for an entire organization, or even a small part of one. Bookkeeping, accounting, and auditing clerks bring those qualities to work, producing financial records, so that organizations know exactly how much money they've spent, what is owed to them, and their total profits and losses. Bookkeeping, accounting, and auditing clerks use specialized computer accounting software to enter information from receipts or bills. They may handle payroll, billing, purchasing, and monitor overdue bills. Effective bookkeeping requires requires regular communication with clients as well. Some clerks are full-charge bookkeepers who oversee an entire organization's books. Others, especially at larger companies, are accounting clerks who handle specific tasks. They all use basic math throughout the day. Most bookkeeping, accounting, and auditing clerks work full-time in offices, although part-time schedules are not uncommon. Additional hours may be required for audits during tax season or to meet end-of-fiscal year deadlines. Although a high school diploma or equivalent is required, most employers prefer candidates with some college coursework in accounting. On-the-job training can last up to 1 year. Clerks must have basic math and computer skills, including knowledge of spreadsheets and bookkeeping software.
Hi, in this video you will learn about the organizational structure of a typical accounting department. The accounting department is an integral department of any business or organization. With a proper structure in place, everyone within the department would have a set of roles and duties that are under their responsibility. In smaller companies, all the below functions could be handled by one person. A typical accounting department can be structured around the following functions. 1. CFO or Chief Financial Officer is responsible for the financial planning, record keeping, as well as financial reporting to higher management. The CFO is also referred to as the right hand of the CEO. 2. Chief Accountant. The Chief Accountant has many duties and responsibilities, namely managing his accounting team and generating financial statements. 3. Management accountants are risk managers, budgeters, planners, strategists, and decision makers. They do the work that helps the company's owner, manager, or board of directors make better decisions. 4. Payroll and fixed assets accountants looks after the processing of all the organization's payroll, paying taxes on salaries, deductions for pensions, social security subscriptions, and more. Depending on the size of the department, they could also be responsible for managing and registering the organization's fixed assets. 5. Accounts payable, AP officer, responsible for managing the accounts payable for the company. They reconcile supplier statements, verify that purchase orders are available, and prepare the payments for the suppliers. 6. Accounts receivable, AR officer, responsible for managing the debtors or accounts receivables of the organization. They invoice their customers and follow up for payment. Their role is very important, as the quicker invoices are settled, the healthier the company will be, as there would be more funds to use in the operations. 7. Assistant accountants generally look after petty cash, deposits, daily cash, and check collections, as well as processing other journal entries. When the structure is clear, duties are well known, and you have the right people with the right qualifications and experiences, then you will be able to count on your department to manage your organization's funds.